Hi, I'm Ram Akili, CEO of Confidence Wealth. We just finished our January investment committee meeting. We had some great discussions on the latest in the market and the news. I'm going to have Chris here give you some of the highlights. Chris?
Thanks, Ram. Let's get started, everybody. So we always start off, not that it's changed much month over month, but right. So we'll start off with a review of what happened last year. So again, commodities up, cash is back as an actual asset class for the first time in a few years. I think next year, if yields stay up, we're going to see an interesting thing where cash might get you, 3 or 4% again, or these short-term bonds. Everything else is down, right? Down double digits. The reality is, though, and I was talking to my neighbor this morning at the bus stop, stocks are only down 18%. 18% down feels like a lot because if you look back, stock market has just been on a tear since the financial crisis. Stocks being down 18% isn't 37% in the financial crisis, or it was even the peak to trough was even higher than that, right? So 50% in the financial crisis, 50-60% .com, 18% down isn't a huge deal, right? It's not. It feels like a lot, and the reason I think it feels like a lot is because bonds are down 13%, and that is a huge deal. That stable, reliable fixed income, which is supposed to give you 4 or 5% with a low risk, losing 13%. That hasn't happened in, 40 years, something like that, right? The 60-40 hasn't been down 14% like it is this year in quite some time. Again, back to 2008, where, a blended portfolio down 20% still. The bright side, I think, going forward, people are like, bonds lose 13%. How are we ever going to make that up? Well, the answer is now bonds are yielding 4%, 5%. So they can make up a good chunk of that just off of that yield, right? So there's a couple ways forward. Either inflation stays high, the Fed raises rates to 10%, and everything, goes to hell in a handbasket and bonds are down again. That's not the likely scenario, though. The Fed's going to raise maybe a little bit more, but bonds are going to make up some of their losses from last year with that yield. And then sort of the bull case for bonds is that we have a slight recession. The Fed has to cut 1%, 2%, and then bonds get a little bit of the bump out of that too. So 18% isn't a huge loss for stocks. I think that's sort of where I'm going to lead. This is the PE ratio of the S&P 500. In terms of long-term valuations, coming into 2021, 2022, stocks were certainly overvalued, right? That post-COVID bump pushed stocks into the stratosphere. They've only come down to a long run average valuation. So this isn't like 2008 where, stocks are at a -2 standard deviation valuation, which means they're super undervalued. This is more like the .com where they were overvalued and now they just kind of came back to earth. So we're back to like 01, 02. And the reason I say that is, back to my neighbor, he's like, oh, should I pile into stocks? Is this a good time? Is this a buying opportunity? And the answer is we don't know, right? We don't know if stocks are going to go up or they might go down further. I remember in 2008, for those of us who were in the industry, you were seeing like high quality companies at rock bottom prices. The Dow Jones was at like 6,500. Like things were at rock bottom. Like we knew it was probably a good buying opportunity for the long term. But I don't get that sense here because stocks are just sort of average valuations at this point. We don't know that it's a home run for stocks right now. In the short term, in the long term, if you're a long run investor, or you're sticking with the plan, doesn't matter. Stocks are going to go up over the long run. Again, this is a crazy chart, but sort of just focus on the second line here. So this is core bonds. This is just our BND sort of position, right? Just core traditional fixed income. The fixed income is a pretty good buying opportunity, right? So in terms of valuations, they are pretty well undervalued, at least that same one standard deviation. Given the yields, given where the Fed might go, if you were going to put some money somewhere, it might be to bonds, right? Short bonds are yielding, we'll see it in a little bit, maybe 4%, 4.5%. They're not going to get affected much if rates go, a little bit higher. If you can lock in some long-term CDs, cash, short bonds, things like that, that might be where people are kind of looking right now as if you want to put some money to work, if you did put some cash on the side, bonds, especially short bonds, might be somewhere, clients can park some money, get that yield without much risk. So that's kind of what Wall Street's sort of thinking is stocks for the long run And short bonds, might be, a sort of a short-term play. Everything we're going to hear from here on out is, will we or won't we hit a recession, right? I track all kinds of Wall Street news articles. I get sent, summaries every day. And every email I open is Goldman Sachs says U.S. is not going to hit a recession. BlackRock says U.S. might hit it. Like every day you're going to get somebody saying they are going to be a recession. There's not going to be a recession. We don't know. We talk about that endlessly. The warning signs, they're starting to turn yellow and orange, right? But we're still not seeing the reds we saw early in COVID or, late 2020, early 21. So there are some good signs still in the economy. There are some, signs of slowing, but there's no sort of red flags. We're definitely going to hit a recession. Across the globe. This is the sort of PMI, Purchasing Managers Indexes, sort of a manufacturing sign, right? See all that red from 2020, financial crisis. We had a little, downturn in Europe during their, the Euro crisis. We're starting to see some yellows and oranges again in that. So over the next couple months, we're going to keep watching some of these recession indicators. The job market is super strong, at a high level. So the Fed looks at how many job openings are there for every job seeker. In bad times, there's, 5 job seekers for every job opening, right? That's sort of down here, this level. Financial crisis back in the 80s. We got close to that in the dot-com. We're at almost 1 3/4 jobs for every job seeker, right? So there's just not enough people to hire. It doesn't feel very, very recession-y when, we were at 2, now we're at 1.7. There's a long way to go to get down to 1 job for every 2 people, right? We're flipped. There's almost 2 jobs for every job seeker right now. People are quitting because they can get better jobs. The layoffs are still fairly low. We're starting to see a few thousand here and there. Wall Street's laying some people off, Amazon. But again, the job market is strong. The one area we are sort of looking at is, home prices, right? Everyone's got to live somewhere. The most important indicator, again, I don't make this, JP Morgan loves to put 3, 4, 5 charts on each slide. But this chart on the top right here, housing affordability has plummeted, right, to 40-year low maybe. This is what's driving a lot of inflation right now is, so-called shelter costs. There's just not a lot of vacancies. There's not a lot of homes to buy. But when we look at the breakdown for where inflation is, if we remember way back in 2021, I know I was looking for a car at that point, used cars, new cars, were a lot of where that inflation was coming from. And then it sort of, that fizzled out. And then we shifted into food, electricity, natural gas, those prices were up. Now those have come back to earth. Now we're down here into things like shelter, right? The cost of, renting or buying a home. Those are that's the area that we're seeing inflation in right now. So, the Fed said inflation was transitory. I think that was their made up word. And it sort of was. They were kind of right. We had inflation sort of here, and then it moved up to energy and then food and now shelter. So it's inflation overall. It's been persistent, but it's kind of been moving around. But, something to keep in mind that could be recessionary is that, the cost of rent, right? People can't afford to live in apartments, things like that. Unemployment, these charts haven't changed much. Unemployment is really low. Wage growth has come down a little bit, but it's still above sort of the long run average. When there's 2 jobs for every job seeker, wages are going to keep going up. But inflation has come down. So the tricky thing with inflation is we always quote inflation as being a year-over-year number. So what is inflation now compared to 12 months ago, 1 year ago? So we had a huge spike here. So for the next 6 months, every inflation print we use is going to go back year over year, going to kind of include this spike in it. As we go month to month, these headline numbers were 9.5, then it came to 9, 8.5, 8. Now we're down to 7.1. the reduction in these CPI numbers, it's going to be slow just because that spike was so big and it's a year over year number. So if the Fed is only looking at these year over year numbers, and they're looking at a lot of other things, but that's the one that gets reported the most, it's not going to get down to 5% again quite just yet. It's going to be a slow roll off. And then if things continue and we get away from this, the peak we had last September, by next September, inflation should likely be back down again in a year over year sense. But the Fed has to slow what they're doing to kind of wait for these inflation numbers to catch up. The Fed tends to start late and end late in terms of their hiking cycles. It sounds like the Fed thinks they need to keep hiking rates. Once again, the market isn't sure. So every couple months, the market says, no, you guys got to slow down. The Fed says no, and they just keep the foot on the gas. So the question is, do they raise a quarter point? Do they keep raising quarter points? Do they slow down? Even the Fed says they're mostly done. If we're here and they think maybe by the end of next year or the year after, we'll be at 5 and then start to come down. The hiking cycle is mostly done, we think. So again, that's sort of a reason why bonds are starting to be more attractive. Again, I know everybody's tired of inflation. Inflation is coming down. We can see sort of these historical numbers, right? So as we start to get away from some of these big numbers here from the summer, I think we'll see numbers back down in the 5s and 6s and maybe even lower. Globally, inflation is starting to come down as well, but the U.S. is in a little bit better shape. All developed markets is coming down as well. And again, we talk about short bonds, right? If you can get 4 3/4 yield right now on some short bonds that aren't going to move much if the Fed keeps raising rates, I think that's a pretty good deal. So again, if I had some extra money to spend, I might put it in short bonds and try to get some of that yield back, in the short run.